You know, every single business has a story to tell. But if you want to know the real story, the unvarnished truth about how it's actually doing, you don't look at the profits they announce. No, you follow the money. And today we're going to do just that. We're diving into the story that cash tells, using one of the most powerful tools in all of finance, the statement of cash flows.
So let me just kick things off with a question for you. Is it possible for a company that looks amazing on paper, I'm talking millions in reported profit, to actually be on the verge of going bankrupt? The answer, believe it or not, is a huge emphatic yes. And understanding why that's possible is the key to understanding how a business really works.
So how can this happen? Well, it all comes down to this one fundamental difference. The profit you see on an income statement, that's based on something called accrual accounting. Honestly, you can just think of it as an opinion. It records a sale the second it's made, even if the customer isn't going to pay you for another 90 days. But cash? Well, cash is a hard fact. It's the real, actual money in the bank that a company needs to pay its employees, its suppliers, and keep the lights on. And let's be real, you can't pay your bills with an opinion.
Now, to make all this crystal clear, we're not just going to talk theory. We're going to follow the journey of a fictional tech startup I've cooked up called Bite-Size AI. By watching how their cash moves through the different stages of their business, we're going to see exactly how this statement works in the real world.
All right, so the statement of cash flows is broken down into three main parts. We're going to start with the most important one, the absolute bedrock, cash flow from operations, or CFO for short. Just think of this as the core engine of the business. It's the heartbeat.
So what is CFO? Well, simply put, it tells us how much cash the company is bringing in just from doing what it's supposed to do every single day. For our friends at Bite-Size AI, that means selling their AI software. A healthy, positive number here is, and I can't stress this enough, the foundation for everything else.
And here's a look at the raw movements. On one side, you've got the inflows. That's the good stuff, cash coming in the door from customers. But on the other side, you've got the outflows, the relentless day-to-day costs of just being in business. We're talking salaries, rent, taxes, all of it. If those inflows aren't consistently bigger than the outflows, that engine we talked about starts to sputter.
So how do we actually get to that final CFO number? Well, most companies use what's called the indirect method. It's like building a bridge. You start on one side of the river with net income. That's the opinion from the income statement. Then you make a series of adjustments to get you across the river to the actual cash, the fact. The first little adjustment is adding back things that were counted as expenses but didn't actually use any cash, like depreciation. Now we get to the most important part of that bridge, adjusting for something called working capital. Let's look at Bite-Size AI's story here. Say their accounts receivable goes up. That means they made a ton of sales, which is great for profit, but they're still waiting for their clients to pay up. So even though profit is high, their cash is not. We have to subtract that to get to the real cash number. On the flip side, what if their accounts payable goes up? Well, that means they've held off on paying their own bills, which means they're keeping cash in their bank account for a little longer. So we add that back. See how it works?
Okay, let's move to the second section of our statement. This is cash flow from investing, or CFI. And I like to think of this as the company planting seeds for the future. It's all about how they're spending money today to grow tomorrow.
Essentially, CFI tracks the cash a company spends on or gets from its big long-term assets. We're not talking about day-to-day stuff here. We're talking about the big strategic moves, buying a new headquarters, upgrading all their computer systems, or even buying a whole other company.
Now, for our startup, Bite-Size AI, you're going to see a ton of outflows here. They're buying powerful new servers to handle more customers. That's a big capital expenditure, or CapEx. Maybe they even acquire a smaller competitor to snatch up their tech. For any company that's trying to grow, you almost always want to see a lot of cash going out the door right here.
And that brings us to a really crucial point, and it's a little counterintuitive. In this investing section, a big negative number is often a fantastic sign. It shows that the company's leadership is confident. They're taking cash and they're plowing it right back into the business to build something bigger and better for the future. It's a huge signal of ambition.
So if operations are the engine and investing is the roadmap, where does the fuel come from? Well, that brings us to our last section, cash flow from financing, or CFF. This right here is the company's fuel tank.
CFF tracks the flow of cash between a company and its owners, the shareholders, and its lenders, the banks. It basically shows us how a business gets money to run and how it pays that money back.
For a startup like Bite-Size AI, the inflows here are absolutely vital.
They're issuing stock to investors or taking out a big loan to build out their team. But for a big, mature company, you'd probably expect to see more outflows. They're so strong financially that they can pay back debt, pay out dividends to their shareholders, or even buy back their own stock.
So you see, the story here completely depends on the company's stage of life. A positive number isn't automatically good, and a negative number isn't automatically bad. It is all about context. For bite size, a big positive CFF is fantastic. It's the fuel they need to grow. For a corporate giant, a negative CFF is a sign of incredible financial strength.
Okay, so we've looked at all three parts in isolation. But the real magic, the real story, happens when you put them all together and see how they interact.
This is where it all clicks. By combining the signs, positive or negative, from each section, you can see these really clear patterns. Look at the growth stage row. That's bite-size AI. Positive cash from its core business, big spending on investing, and bringing in cash from financing. That is the classic signature of a company that's all in on expansion. Now contrast that with a mature company. A fire hose of cash from operations is funding everything. And then you have the danger zone, distress. Operations are bleeding cash, and the company is being forced to sell off assets and borrow money just to stay alive. So if you only take one single thing away from this whole explainer, let it be this. A strong, consistently positive cash flow from operations is the bedrock of a healthy business. It is the engine that powers everything. Without it, a company simply can't grow or reward its owners for long without getting into some serious trouble.
And that brings us full circle, right back to that timeless saying in finance. Profit is an opinion, but cash is a fact. The income statement can tell you a version of the story, sure, but the statement of cash flows, that gives you the hard, cold facts. It cuts through all the accounting jargon and just shows you what really happened with the money.
So, I'll leave you with this question. The next time you see a big news headline about some company's record profits, I want you to do me a favor and dig a little deeper. Go find their statement of cash flows. Look past the headline number and ask yourself, what is the real story that the cash is telling me?